How's it going, Option Sharks? This is your option coach here. Today, I'm joining you once more on my terrace. Beautiful day. Check out the background of the building side of the homes. Okay. Yeah, today's clear skies, no clouds, outstanding. All right, so in this video, what I want to cover about is pre-earnings volatility and volume. All right, so anytime there is pre-earnings the week before the earnings or 2 weeks before any company that has their earnings call, you're going to see more premiums because the volatility is higher and the premiums are much juicier, right? So it's not normal. So anytime that is outside of earnings calls, the premiums are normal premiums. And then when you have the week or the two weeks before the week of earnings, you can expect the premiums to be a lot more juicier because there's a lot more volume and volatility around the particular stock. All right, so for this week, we are in today's July 30th. Today, after the bell, is when Robinhood is going to have their earnings call. So this is one of the ticker symbol. Hood is one of the companies that I've been trading for the past 3 to 4 months with my community, and we have made a lot of money, thousands and thousands of dollars, myself and plus my members as well. All right, and we've just been capitalizing it on selling puts. I'm doing put credit spreads, owning the shares, selling covered calls, being very strategic with it. And I'm very bullish on Hood because of what they're doing and the technology that they're in, specializing tokenizing the stock market. And then the team they have is they're doing the great things. They're expanding globally, right? Expanding their total addressable market. So super bullish. But either way, because it is pre-earnings, the premiums on Hood has been super. It's been tremendous, right? One option contract, you can expect anywhere between $200 up to $500 per contract, depending how aggressive you go, or what your sentiment is on. Are you being more picking strike prices closer to the money, right? Or just being a little bit, even if it's a little bit out of the money, the premiums are still very juicy. So during earnings, pre-earnings, you're always going to expect high volatility, high volume. This is the time to capitalize on that if you are long-term and bullish on a particular stock. So in my case, I am bullish and long-term on Hood, and therefore I'm taking advantage of the pre-earnings to sell puts, to sell cover calls, to generate income during this time, right? And then after earnings, that's when the dust settles, and then you can evaluate from there. So particularly pre-earnings, selling puts, doing put credit spreads on the stock that you are bullish on can pay off, will pay off very, very handsomely. And then once the dust settles and the market, after earnings, it cools off, then, and you have positions on it, then you can decide what strike prices you want to sell your cover calls at to preserve your position, right? Because you don't want your shares, you don't want to sell a cover call, and then next you know, after earnings, the stock goes above your strike, blows past your strike, and now you're stuck in a position where you're rolling your cover call, right? So you don't want to do that, but you can be aggressive on the put side, selling put side, and then when the dust settles, then figure out where you want to sell the cover calls at to generate income from ownership. I like to say that because you own the shares, you want to sell the cover call, you want to get paid because you own the shares, right? But you don't want your shares called away because you want to hold on to it. Okay, so either way, if you like what I have shared today, like and subscribe, leave a comment, and like usual, stay tuned for the second half of the video to see an actual live sample of a coaching call that I do with one of my option sharks, how I could help my members and you yourself, if you are in the markets or you want to get into the market, generate anywhere between 3 to 10% per month. Love to help you, and I'll see, and book a time, right? The calendar link is in the description. All right, so then I look forward to speaking to you, and other than that, stay tuned for the second half, and I'll see you guys later. Yeah, so you can see here, look at the screen. Expiration date is 5/16, so this contract is expiring 5/16. You gotta go down, right in the middle.
Okay.
So can you see the expiration date?
Okay.
5/16. So these contracts expire May 16th. The credit that average credit you collected is 0.25. You collected $25 per contract.
So basically it's 175. 50. Okay.
Yeah. So you can see you sold 7 contracts, so it says -7, right?
Okay.
In the same column, everything's there. 0.25, your break even, the number of contracts, -7 means you sold 7. When did you sell these contracts? You did it today, May 12th. And then the left column, that tells you the market value. What are these contracts worth at this very moment? Okay, so at this moment, it's 0.26. You see current price, 0.26?
Yes.
Right, so 7 contracts at 0.26 means that these contracts are worth 182. You collected 175. 182 minus 175 means that you'll be out of pocket of $7 if you try to close it out early. Obviously, we don't want to do that. So this contract, as it gets closer to expiration date, as it approaches May 16th, the current price of 0.26 will start to deteriorate. It'll go to 0.24, 0.23, 0.20, 0.15, 0.12. Once it gets below like 0.10, 0.10, 0.08, that means that the contracts are only worth like $8 per contract. So 8 times 7, that's I believe that's, damn, my math is bad. 48. All right, but obviously we're not going to close it out that early.
8 times 7 is 56.
Oh, 56. Jeez. Very bad. Yeah. So you don't want to realize the profit. You don't want to close it out if there's still more unrealized value to gain from. Even it tells you right now total return is -7, right? Okay. So because the current value of these contracts are 0.26, and then you sold them at 0.25, right? So it's a difference of 0.01. 0.01 means $1, right? So
the current price of, okay, so you're saying the contract is 0.26 is what I got. Wait, I got it at 0.25, right?
0.25. Yes, the value.
Okay, so if the price of the contract goes up, does that mean that I'm losing money?
If it goes, yeah, if the current price of that 0.26 goes higher, then that means that you're not losing money. You just, the value of the contract is higher. Okay.
Oh, the value. So that's what I meant. So the current price at 0.26, as it goes up, that's the value of my contract, or of the contract I'm selling.
These 7 contracts.
Is that a good thing or a bad thing?
Not really, because it doesn't really matter. This is a very passive strategy. You're gonna get, you don't mind getting assigned the shares at 850. Our shares are good stock to own at 850. $7 to 850 is the range that you want to own our share for. Anything higher than 850 is not.
I'm just trying to understand the selling put thing. Okay,
right. So that's why I'm giving you the mechanics of how to read this, how to look at it. So you're just looking at the right and the left. Right side tells you expiration date, tells you how much you collected per contract, which is 0.25, and how many contracts you sold. It shows a -7.
Now, do you get that premium automatically?
Automatically. So if you scroll down,
okay,
scroll down, it'll show you your premium right away. Go down more. There you go. You see your premium, 175. And as you sell more contracts on Archer in the future, we'll have a history. So all your premiums will be shown here. Everything you have collected. That's why Robinhood by far is superior when it comes to user experience. Like everything is right in front of you. Like so easy to read what's going on with the.
I haven't gotten used to Robinhood yet, so.
Well, I mean, so far I'm explaining to you, it's very.
Yeah.
It's not, you didn't have to navigate to multiple windows. If you look at
everything is on one
window.
That's why.
How many windows do we have to navigate on Fidelity? Literally, like, just look at the balance, just look at this. It's like.
Yeah, I see what you're saying. I see everything.
We literally stayed in one window and we know everything about the trade, how the trade's performing, how the value of your contracts, and the total premium you have collected. In the future, when you build a history, you also have the history there. And on the top right, you have your options: buy to close or sell to open. So you have everything in your fingertips.
So So let's just say I have this right here. Do you usually let the expiration expire, or do you close it out?
Yeah. So depending on how much the value of the contract is. Generally, if the current price goes to less than 0.10, then I would like to take profits early to release the collateral. And the collateral gets released and allows me to make another trade earlier to let me capture theta, time decay. Now you'll understand this as we progress, because this is just more like, so
I haven't yet grasped like when I should close it or what should I let it expire.
Yeah, so,
I haven't grasped it yet.
2 things can happen. You can let it expire naturally, which is totally fine. Or if you see that by Wednesday or Thursday, the current price of these contracts are less than 0.10, then we can buy to close. You see the action's already open. Buy to close, pay some money to close it out, right? And then that collateral gets released back. And then you can make another trade with that collateral.
When you buy to close, how do you know when to buy to close? When it's below 0.10?
You can buy to close whenever, but you want to buy to close when it's below your average credit. Because your average credit is 0.25 and the current price is 0.26. So right now, if you close it now, you'll be out of pocket. You'll be negative $7, right? Because it's 182 to close it. You collected 175.
Okay, I think I can.
You get what I mean? If you close it out now just look at the current price and look at the average credit. You got $25 per contract. The current price of these contracts are 0.26. Just look at the left and right column. That's all. It tells you everything you need. Each contract right now is worth 0.26 per contract. You sold the contract at 0.25. So
that means the worth of my contract went up. Is that correct?
No, the contracts are -7, -$7. Because 0.26 times 7, $26 times 7 is 182. 0.25 times 7 is 175. 182 minus 175 is -$7. So these contracts, if you were to close it out now, you'll lose $7. But as time goes,
for each contract, right?
No, total $7.
Oh,
because the difference between 0.26 and 0.25 is 0.01.
Okay.
You see the average credit in the current price?
I'm confused with the average credit and the current price. So if I'm selling a put, right? Like I think I haven't grasped the concept of the selling put part. Okay, if I sell a put, and the average credit is 25 cents, right? And right now it went up by a penny or whatever, by $1, right?
Yeah, you don't want it to go up. If you're buying options, you want the current price to deteriorate. And the only way for the price to deteriorate, go down, is time decay as we progress towards the May 16th.
That's what I was trying to ask you.
Yeah, because you've been doing buying options. You haven't sold. You've been thinking about buying. When you buy options, you need it to go up. You need it to go into money. You need the current price to go higher so you can sell to close to take profit. You see it, the action for this to close is buy to close. When you buy it, right? So when you buy options, your action to close the contract is sell to close to take profit. When you are selling options, your action is buy to close to take profit. Take profit meaning paying a small fee because you already collected the profit. The 175 you collected up front. You get paid when you sell options. When you buy options, you pay a debit, and then you need to watch your stocks go up, increase in value, and then your action will be sell to close to take profit. And in this case, when you're selling options, you can just let it be on autopilot and not do anything,
Or you can buy to close it, just pay a small amount, and just because the contracts are getting worthless, and no point tying up your collateral for another 2-3 days when you can use that collateral to do another trade, sell another option. Yeah, okay. You'll learn this as we do it. You learn as we go, because I'm just telling you. But when you start clicking the buttons, you'll see what I mean. So for today, all you need to know is that you sold 7 contracts of Archer at 0.25, which is $25 per contract. You collected $175. On Wednesday or Thursday, we'll revisit this and we can talk about. We'll see where the current price is at. Right?
I'm gonna go back and look at the videos tonight to better understand the selling of like the prices, like this whole thing like I'm looking at right now. I really, to be honest, I'm confused by it.
Yeah,
I see, like when Henry's explaining it to me and I'm like listening to what he's saying, I understand the concept, but looking at this confuses me.
Just keep it very simple. Left column, right column. That's all.
Yeah, this whole thing confuses me because I'm trying to understand, like, it's his current price. So basically, if you sell a put options, don't you need the price to go up so that you can make money? So that way you
already made the money.
So that you say you won't get assigned, basically.
Yeah, you when you sell, you collect income credit up front. You get paid up front. Correct. So that 175 you collected. And the reason why you collected 175 is because you sold each contract at $25 per contract, 0.25. 0.25 means $25. $25 times 7 is 175. Right? And that's it. And then once you sell the contracts, these contracts will appreciate or depreciate in value. And currently, the contracts, if you look at the left side, it's at 0.26. So 0.26 times 7 gives you a total of 182. 182 minus 175 is minus 7. So if you were to buy the close and close these contracts out, you'll be in the negative for $7. But obviously, we're not going to do that. Yeah, we're not going to do that. We're just going to let time decay, because time decay is what's going to affect that current price. As we approach May 16th, that 0.26 number will keep changing.
The 0.26 number. Okay. So I forgot what the when you're looking for this, the delta that you're looking for is less.
In this case, we're not focusing too much on delta because Archer, I have a lot of experience with it. I've been doing this stock for like 6 months or more. So I know this is the perfect stock for smaller portfolios. But for my analysis is that you want to sell puts on Archer between $7 and $8.50. Anything higher than $8.50 is not worth selling puts on Archer. So in this case, we're in the perfect sweet spot, $8.50, which is the max.
Okay. So we just leave this.
We'll catch up on tomorrow. We can catch up again. So to trade on your other accounts. All right. And then let's see. And then I would say Thursday we'll revisit this portfolio to see where the current price is, what the figures look like from there. And then I can walk you through if we were to decide to close them out early and then release the collateral.